Hi traders, you're welcome back to the Forex Geek channel. If you are looking to step up your trading game and unlock a powerful tool that can help you spot potential opportunities in the Forex, crypto, or stock markets, then you are in the right place. In this video, we are going to be talking about one of the most effective indicators used in technical analysis, and that is the stochastic indicator. Okay? Whether you are just starting out or you are a seasoned trader, understanding how to use the stochastic oscillator is a must. In this video, we will go through the best strategies for trading with the stochastic, and I will explain how you can use it to make more informed decisions in your trade. So let us just jump right into it. First things first, let us talk about what the stochastic indicator actually is. Now, let me add the indicator to the chart. Okay. Now, the stochastic oscillator is a momentum oscillator. In simple terms, it measures the momentum of an asset by comparing its current price to a range of its prices over a specific period of time. Now, what makes the stochastic unique is that it works by telling us when an asset is potentially overbought or oversold, as we can see here, which can be a sign that a reversal is coming. Now, the stochastic is displayed on a scale from 0 to 100. You can see that clearly. Values above 80 are typically considered overbought, and values below 20 are considered oversold. So this helps you to identify potential, turning points in the market. But just having the stochastic indicator is not enough. You need to know how to read it, and more importantly, how to use it in your trading strategies. So that is exactly what we're going to be breaking down in this video. Okay, let us start with the classic stochastic strategy, which is one of the most popular ways to trade with this indicator. In this strategy, you're going to be focusing on the crossovers, right? Here's how it works. When the percentage K line crosses above the percentage D line. Remember that the percentage K line is this green line, all right? So when the percentage K line crosses above the percentage D line and the stochastic is below the 20 level, it can signal that the asset is oversold and could be ready for a reversal to the upside. So this is a potential buy signal, all right? On the flip side, when the percentage K line crosses below the percentage D line and the stochastic is above 80, it signals that the asset is overbought and a reversal to the to the downside. A reversal to the downside could be in the cards. Now this would be your potential sell signal. So this is one of the most straightforward ways to use the stochastic indicator in your trades. You buy low and you sell high. The stochastic helps you spot when these conditions might occur. All right. Now let us level up a bit with advanced strategies. While the stochastic on its own is powerful, combining it with other indicators can make your trade setups even more reliable. A great example is combining the stochastic with the RSI. Combining the stochastic oscillator with the relative strength index. Now, both are momentum oscillators, but they each give you a slightly different perspective on market conditions. While the stochastic measures price momentum, the RSI tells you whether an asset is overbought or oversold in terms of momentum strength. So when you use them together, you can confirm signals from one indicator with the other. For example, if both the stochastic and the RSI are in oversold territory, you could have a stronger confirmation that a potential bullish reversal is on the horizon. Likewise, if both indicators are in the overbought territory, it could signal a stronger potential for a bearish reversal. So this kind of confluence, when two or more indicators give the same signal, can significantly increase the probability of a successful trade. Okay? Now let us dive into a more advanced technique, which is divergence. Now, divergence occurs when the price of an asset is moving in one direction, but the stochastic is moving in the opposite direction. This is often a sign that the trend is losing strength and a reversal could be coming. Okay? For example, we can see what happened here. We had the price making lower highs, but you can see that the indicator made, lower lows. The indicator made higher lows. So this indicated that a bullish reversal was incoming. This is what we call a regular bullish divergence. Okay? We have two main types of divergence, which are the regular divergence and the hidden divergence. Okay, we've talked about that in previous videos. You may want to check that out. But basically, the regular divergence happens when the price is making maybe a higher high while the stochastic is making a lower high, or when the price is making a lower low and the stochastic is making a higher low. All right, so that signals weakening momentum and a potential reversal, to the opposite side. Okay, then for a hidden divergence, it happens when the price is making a lower low, but the stochastic is making, for example, when price is making a higher low, a higher low, but the indicator is making a lower low. Now, this is what we call a hidden bullish divergence, because it signifies continuation. There could be a bullish continuation, and consider is exactly what happened, right? So basically, when price is making new lows, indicator is making lower lows, or price is making lower highs, indicator is making higher highs, it could mean a hidden divergence. So understanding divergence can be a game changer. It helps you spot reversals early and gives you an edge over other traders who are only looking at price action without considering momentum. One more strategy that I want to mention is using the stochastic indicator in a range-bound market. In range-bound markets, price moves within a defined range. All right, price moves within a defined range in a range-bound market. Looking for a good example now. Okay, we can use this as an example. Basically, price was moving so in a range bound market, price moves within a defined range. There is no clear trend, and prices bounce between support and resistance. So in these conditions, the stochastic can help you spot potential reversals when the price hits key levels within the range. For example, when the price is near support, and the stochastic shows that the asset is oversold, it might be time to look for a buy signal. Similarly, when the price is near resistance and the stochastic shows that the asset is overbought, it might be time to sell. So this strategy is effective when the market is not trending, but is moving within a clear price range. So those are just a few of the most effective strategies to trade using the stochastic indicator. By understanding its fundamentals and combining it with other indicators, you'll be able to spot potential opportunities across Forex, crypto, and stocks. Whether you are a beginner or an experienced trader, mastering the stochastic indicator will give you an edge in understanding market momentum and improving your trade setups. If you found this video helpful, don't forget to like it, subscribe to the channel, and click the bell icon so you don't miss out on any of our future trading strategies. Until next time, happy trading.